Welcome. Today, we're diving into the world of mutual funds and how you can choose the right ones for your investment portfolio. With so many options available, it's easy to feel overwhelmed, especially when looking at your 401k or IRA choices. But don't worry, by breaking down the process into 5 clear steps, you'll gain the confidence to make informed decisions that align with your financial goals. Whether you're a seasoned investor or just starting out, understanding these fundamentals will help you build lasting wealth and avoid common pitfalls. Let's get started on your journey to smarter investing. Mutual funds are a popular investment vehicle because they offer broad diversification, professional management, and economies of scale. Instead of picking individual stocks or bonds, you invest in a pool managed by experts. This approach reduces risk and makes investing accessible, even if you don't have the time or expertise to analyze every security yourself. Plus, mutual funds can be tailored to fit various goals, whether you're saving for retirement, a home, or your child's education. Understanding why mutual funds are beneficial is the first step to making them work for you. First step in choosing the right mutual fund is to match your fund selection to your asset allocation plan. Asset allocation is simply how you divide your investments among different categories like US stocks, international stocks, bonds, and real estate. For example, if your plan calls for 30% US stocks and 20% international stocks, you'll want to pick funds that specifically target those areas. Avoid funds that mix categories like balanced or all-world funds if you want precise control. Always check the fund's prospectus or summary page to see exactly what assets it holds. Asset allocation is a foundational concept in investing. It determines how much of your portfolio goes into different asset classes like stocks, bonds, or real estate. The right mix depends on your goals, risk tolerance, and investment timeline. For instance, younger investors might lean more towards stocks for growth, while those nearing retirement may prefer bonds for stability. Having a clear asset allocation plan helps you stay disciplined, especially when markets fluctuate. Remember, your mutual fund choices should fit neatly into this plan, not the other way around. Any mutual funds are actively managed, meaning professionals try to beat the market by picking winners and avoiding losers. While this sounds appealing, research shows that very few active managers outperform the market over the long term. In fact, the odds of consistently picking a winning active fund are slim. Instead of chasing performance, focus on strategies that are proven to work. By understanding the limitations of active management, you can avoid costly mistakes and set yourself up for better long-term results. Index funds are a type of mutual fund that simply aim to match the performance of a specific market index like the S&P 500. They don't try to beat the market, they just track it. The beauty of index funds is their simplicity and low cost. Because they require less management, fees are much lower, and they tend to outperform most actively managed funds over time. If you want to capture the market's return without unnecessary risk or expense, index funds are often your best bet. Main reason index funds outperform most active funds is cost. Active managers spend heavily on research, trading, and salaries, which eats into your returns. Index funds, on the other hand, are inexpensive to run and have lower turnover, making them more tax efficient. Over decades, these small savings add up, leaving more money in your pocket. Accepting market returns rather than chasing elusive outperformance is a powerful mindset shift for long-term investors. Investment costs matter a lot. Every dollar you pay in fees is a dollar less working for your future. Look for mutual funds with low expense ratios, ideally under 0.2%. Avoid funds with high management fees, marketing fees, 12b1, or sales loads. Over time, even a 1% difference in fees can cut your wealth in half. The best predictor of future mutual fund performance is low cost, so make this a top priority when choosing funds. Mutual fund fees come in several forms. The most common is the expense ratio, which covers the cost of running the fund. Some funds also charge marketing fees or commissions known as loads. Front-end loads are paid when you buy, back-end loads when you sell, and ongoing loads are built into higher expense ratios. The best funds have no loads at all. Always read the fund's prospectus to understand exactly what you're paying, and remember, lower is better. It's tempting to pick funds based on their recent performance, but studies show this is a losing strategy. The best performing funds one year often lag the next. Instead, stick to your written investment plan and rebalance as needed. If your allocation to US stocks drops below your target, buy more to get back on track. This disciplined approach helps you buy low and sell high rather than the other way around. Wondering if a mutual fund is actively or passively managed? Start by checking the expense ratio. Index funds are usually much cheaper. Next, read the fund's prospectus and look for words like index or benchmark. If the strategy focuses on tracking a market index, it's likely passive. If it talks about picking undervalued stocks or beating the market, it's active. This simple check can help you avoid unnecessary fees and complexity. Implementing asset allocation isn't just theory, it's about putting your plan into action. Many investors use a mix of index funds to cover US stocks, international stocks, and bonds. For example, a simple 3-fund portfolio might include an S&P 500 index fund, a total bond market fund, and a total international stock fund. Adjust the percentages to match your risk tolerance and goals. Remember, simplicity often leads to better results. Investors often fall into traps like paying high fees, chasing hot funds, or ignoring their asset allocation. Another common mistake is not rebalancing, which can lead to unintended risk. Some get caught up in complex strategies or over-diversify with too many funds. The key is to keep things simple, focus on low costs, and stick to your plan. By avoiding these pitfalls, you'll be well on your way to investment success. While it's possible to manage your investments on your own, some people prefer to work with a financial advisor. If you do, seek out fee-only advisors who act in your best interest. Avoid those who earn commissions from selling specific funds, as this creates conflicts of interest. Even if you use an advisor, understanding these 5 steps will help you evaluate their advice and ensure your portfolio stays on track. Recap: choosing the right mutual funds comes down to 5 key steps. Match funds to your asset allocation, avoid active management traps, embrace index funds, keep costs low, and don't chase performance. By following these principles, you'll build a portfolio that supports your goals and stands the test of time. Remember, investing is a long-term journey. Stay disciplined, review your plan regularly, and keep learning. Your future self will thank you.